I will begin this installment by mentioning that I am not a financial advisor, and this is for informational and educational purposes only. The strategy I'm about to outline involves high-risk, short-term trading of volatile assets. There is a real risk of loss. Market conditions are unpredictable, and by following this or any trading strategy, it is possible to lose some or all of your invested capital. Please do your own due diligence and never trade money you cannot afford to lose. All right, so good morning. We have executed our exit order on XLF. Let's take a look at the scoreboard. We started Monday with $500 and we ended Friday with $496. We took a $4 loss. In percentage terms, that's a loss of 0.8%. Now, the amateur investor looks at this and feels frustration. They think I wasted my time, I lost my money, but a professional investor looks at this differently. We didn't lose money, we paid a $4 premium for information and liquidity. We entered the trade on a theory that bank earnings would ignite a rally. The earnings came out, the data changed, and the market voted no. The market decided to sell the news. We respected that vote. We didn't argue with the market. We didn't double down. We took our loss. So let's conduct a quick post-mortem. Why did XLF drop? We saw the reports. JC Morgan and Wells Fargo posted decent numbers, but in this environment, decent wasn't enough. The stock prices had already run up before we bought on Monday. The expectation was perfection. When the banks delivered good instead of perfect, the algorithm sold. This is a classic buy the rumor, sell the news event. But here is the victory. It was controlled demolition. Because we were in a basket and not a single stock, a 0.8% drop is a scratch. If we had bet everything on a single bank that missed earnings, that $4 loss could have easily been 40. Our risk management worked exactly as designed. I want to highlight the most important thing that we did today, and that was we sold. At 12 p.m. on Friday, we were down. The temptation to hold is massive. The emotional brain says, just hold it until Monday. It'll bounce back. I don't want to book a loss. That mindset is what kills portfolios. By selling today, we eliminated weekend risk. Whatever happens Saturday and Sunday, geopolitical trouble, a CEO scandal, a downgrade, we're immune. We paid $4 to ensure that we sleep soundly this weekend. We adhered to the system. A strategy is only a strategy if you follow it when it's losing. If you only follow the rules when you're winning, you're not a trader, you're a gambler on a lucky streak. So, with all that said, let's look ahead as we head into our next week. First, let's take a look at the calendar. Monday is Martin Luther King Jr. Day. The markets are closed. This creates a gap risk. News will happen over the next 3 days. Our target for week 2 is XLC, the Communication Services Select Sector SPDR. This sector holds the giants of the internet, Meta, Google, Disney, and the company that is about to set the tone for the entire week, Netflix. So why are we going with XLC? Because this Tuesday afternoon, January 20th, after the closing bell, Netflix reports its Q4 earnings. This is the single most important event of the week, but this isn't just about subscriber numbers anymore. This is a massive narrative unfolding right now that we need to trade. You've seen the headlines. Netflix has been under pressure, down nearly 30% from their highs last year. The market is nervous because the rumors surrounding a potential acquisition of Warner Brothers. Wall Street hates uncertainty. Is Netflix buying them? Is it an all-cash deal? The uncertainty has compressed the stock price. And when you compress a spring, It'll eventually pop. We are betting that the earnings report on Tuesday night will provide clarity. If Netflix announces a strong growth in ad tier subscription plans, or simply clears up the acquisition rumors, we could see a massive relief rally on Wednesday morning. So you might be asking, if Netflix is the play, why don't we just buy Netflix? Which would be a great question. The answer is we need to manage risk. If Netflix misses earnings, or if the merger news is bad, the stock could drop 10, 15% within minutes. This is a binary risk that we don't want to take. Instead, we buy XLC. XLC is a basket. Yes, it has about 5% Netflix, but it also has Meta and Alphabet, which make up nearly 40% of the fund. If Netflix flies, it drags the whole sector up, sentiment improves, and XLC goes green. If Netflix crashes, the blow is softened by Meta and Google, which are stable and haven't reported yet. We are using XLC to get exposure to the upside of the Netflix event. Without betting entirely on a single earnings call, we are buying the neighborhood, not just the house that frankly might be on fire. So here's the plan for week 2. On Tuesday at 9:30, we'll put our $496 in XLC. Tuesday night is the Netflix earnings report. This is where it all happens. We'll hold through Friday and we'll sell in the afternoon. We don't really care about the 10-year outlook for streaming at this point. We only care about the price action between Tuesday morning and Friday that will be driven by the Netflix earnings report. This week is about capturing the volatility of the first major tech earnings of 2026. The market is expecting fireworks from Netflix. We are positioning ourselves to catch the sparks, but from a safe distance.